This is Bazaar Morning Call. Broadcasting live from the CNBC TV 18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Start of a fresh 5-day week. Not a holiday shortened week, a full week. This is Monday morning. We're coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, morning.
Hi, good morning. A 5-day week and so many cues to track as well. But the market has been okay, sideways. It's just that the mid and small caps are starting to get a bit tricky now. So that is where a bit of caution should lie. But otherwise, not too bad.
Well, not too bad. And when you come off a long weekend as well, things feel good, right? So we're ready to take on the 5-day week. And then we get a couple of weeks where we get 4-day weeks.
When is the next one, Nigel?
The following one. The folling one after that as well.
That's a 3-day week, I think, right? There's one which is...
No, I think both
okay.
are 4.
Both are 4 days, okay.
I'm guessing so.
I think there is 1 week where there is I think there's a Monday and then a Friday off.
As long as it's not a 5-day week, it's good. Right? So we pull through this
All right,
one.
this one is a 5-day week, so let's kick it off. And we're looking forward to it. It's going to be a big one because of many factors. And let's just sort of pick up from where we left off last Thursday, right? And that's the last trading session because, I mean, then the Friday was a market holiday. So, you know, if you want to summarize, US jobs data was the big data point which was to be expected on Friday as we sort of as we said goodbye on Thursday, right? And we got that. Now, the market reaction actually was quite sort of a flip-flop because first markets thought that the jobs data is actually pretty strong because the numbers were strong. But then slowly the realization happened that the numbers actually are soft, weaker because the detail was weaker, not the headline jobs number, but the detail was weaker. And as a result of which, everything turned. Equities actually ended down. So if you look at the NASDAQ over the last 2 days, that is a cumulative change over Thursday and Friday, it is only 0.35% up. But each of the days, Thursday, we had a 1% plus move, and then Friday, we had a 1% plus move. 1% up, 1% plus down. That's essentially the story over the last 2 trading sessions. And it was largely on the back of course, I mean, the reversal on Friday happened on the back of the jobs data. This is, again, I mean, the change cumulatively over Thursday and Friday, which we will react to. Not very much. The 10-year is down 3 basis points, neither here nor there. And, of course, you've got the dollar index, which is weaker at about 102, under 103, 102.71, which is not exactly bad news for the market. It's good news. Dollar lower is good news for emerging market flows. Now, this is the number, right? So it was construed to be, I'm using the word construed because still there is a fair bit of debate whether this is a healthy number, bad number. But it was the market reaction at the end of the day is what matters. And it was taken as a dovish number. Headline job addition was strong, but unemployment rate, average hourly earnings were all weak. I mean, the numbers were weaker than what the estimates out there were. Now, what does it do? I mean, it basically brings forward expectations that the one data point which the market wanted, the US market wanted to sort of come off a little bit, it was running too hot, was the labor market data, and that is actually coming off. So maybe the economy is starting to weaken as planned, as desired by the Fed. But we will not hear from any Fed members because they're in a blackout period ahead of the March FOMC. The big data point, there's going to be one more data point, which is the core CPI number this week. And I think this will be the big one that perhaps the last and the big one which we get before we get into the March FOMC, where no change is expected. I mean, the first cut still is expected only in the middle of this particular year. China's NPC sort of ends. That's the big conference there. Yields in China have fallen in 11 of the past 12 weeks. I found that data point pretty stunning. And that basically shows you that the market is extremely worried about the deflationary sort of tendencies in the economy, especially with regards to the property sector there. Here in India, I mean, I think, you know, we've been broadly okay. Something or the other has been firing and not allowing the market to come off, even as broader markets, mid caps and small caps have come off, right? I mean, for example, last week, the Nifty did nothing, but the small cap index was down 3%. So stocks in many sectors, in many areas are off 10, 15%, if not more. But sort of circling back to the Nifty levels, we need to break above 22,600 broadly. Those are Fibonacci extension levels for the uptrend. I mean, that's essentially logically the next target. We're pretty much at all-time highs. And on the downside, I mean, Wednesday's low, which is 22,224, should be defended. I mean, only if you get a break under it, below it, you basically say that the up move is under some threat. And on the Nifty Bank, I mean, some supports here really. The question has been whether, for example, Wednesday on Nifty Bank, we saw a big rally. There was no follow-through on Thursday. So I'm just putting out support. We'll see if the Bank Nifty looks strong and moves up. But supports are at the hourly averages, 47,800 and then 47,490. These are very, very near-term support levels. For the large caps, I mean, the trade, of course, has been to buy the dips. But it's not very clear because there is a divergence in the broader market, which is weaker, which is consolidating, and the large caps, because of something or the other firing, which continues to move higher. So the large cap indices are still telling you to buy the dips, whereas the broader market, there is a bit of distribution and come off and tapering off, which is happening. Sonia.
Absolutely. I take your point entirely. While the headline index may not be showing the kind of pressure, we saw on Thursday the mid-cap index was down about 1%. Yeah. So the Nifty is holding on to those levels of 22,500 thereabouts, but the real pressure really is kicking in to the broader market. So there is a shift that we're seeing from mid and small caps to large caps. Just look at what's happened this month so far. The Nifty is up 2.5%, while the Nifty mid-cap index is up just 1.3%, and the Nifty small cap index is actually down 1.7%. So the best way to trade so far is to be prudent, to stay cautious in the mid and small cap space. On Thursday also, if you saw, there were a lot of smaller banks that were under pressure, whether it was UCO Bank, IOC, etc. So keep that on your radar, that banks could be a bit vulnerable to the price action going forward as the pressure builds up in the mid and small cap space. In terms of flows, yes, there was very large numbers that came in. FI is about 7,300 crores, but it looked big on Thursday because of the large block deals that took place. So there was a large block deal on M&M where the promoters sold 93 lakh shares worth almost 1,800 crores. There was a large deal on Bharti Airtel as well, where Singtel sold about 4.9 crore shares at 1193 rupees a share. So keep an eye out on that. I'm also watching out for some of the insurance companies this morning because there was very strong insurance data that came through on February. More on that later. But three companies in focus: Max Life, SBI Life and ICICI Pru. Both the premium data has gone up substantially. The Feb premium for Max Life went up 51%, but even the APA data is strong across the board. So, this is one space that could gain a bit of traction this morning. But other than that, I think it's the broader market that beckons a bit of attention because there's definitely some risk off that has come through, some money that's being taken off the table. So I would be a bit cautious there.
Well, that's right. And March is normally a volatile month, right, for the broader markets because there is, some kind of profit taking, some kind of tax planning as well. But on Thursday, market participants said enough of this narrative with regard to being cautious in small caps because the small cap index actually was a relative outperformer in comparison to the other indices as well. And, yes, the index has been underperforming, but stock-specific action continues, and I'm just pulling out some of these examples, no big fundamental view on any of them, but there are select stocks that are doing very, very well. So though the index is underperforming, there are a lot of stocks that are giving you opportunities actually to make a lot of money out there. So be very stock-specific action. Don't throw on the towel. Continue looking at some of those stocks in the broader markets, and they're making you big money as well. Now, looking at the Nifty itself, the key trigger for the Nifty to move up from here on is going to be the Nifty Bank, because that's close to around 1.7% away from its fresh all-time highs. If it can get to that mark, well, you'll have the Nifty that will be moving, towards the 23,000 odd mark. So that's the key trigger out there. Ahead of the long weekend, we saw some unwinding of positions. Both on the Nifty and the Nifty Bank, open interest was low on both of them. And the FI positioning as well, they lightened positions and they lightened more amount of shorts than longs. So the short positioning did come down quite a lot. And they continue to remain net short with close to around 58% positions on the short side. In absolute terms, it's around 33,000 contracts. So they remain net short, but not aggressively net short is what I would like to say. On the option side, the 22,500 call and put, both of them were very active, and that's what we call a short straddle. What is it? You pocket the premium of both these two. So, on an average, the total premium you would pocket is around 300 rupees. You pocket that and you say that the Nifty should expire in this range of around 22,200 on the downside to around 22,800 on the upside. So it appears there is a strategy that's at play. And the 20 DMA comes in at around 22,130 or thereabouts. So till that level is holding out, you'll have to say that this market is still in an uptrend. And the Nifty will continue to trend higher as well. Now, the stock that I'm looking at is PVR. The stock ended at the high point of the day. We had the release that, Shaitan, the Ajay Devgan thriller. And after a long time, you're going to be getting 100 crore net collections. So maybe the street is looking to that. Valuations as well in comparison to its average is a little better, though quarter four is going to be soft. So it appears at around this 1350 level odd, that's where you're seeing some buying. That was the low that we saw the last few sessions, and that's the 52-week low as well. So 1350 is an important level that it holds out on the downside. And there was big delivery-based buying as well in Thursday's trading session. So keep an eye out on the stock. It seems to be bouncing off the 1350 odd level. The question is, does it have enough to go ahead and conquer higher levels? Case in point, the 50 DMA. So that's a stock I'll look at. The GIFT 50 suggests a gap up. We'll have to see whether or not the bulls can build on from there.
Okay, by the way, guys, the Oscars are on currently. They're live at the moment. And, you know, the winners are coming through. I think Christopher Nolan is one for Oppenheimer and even Cillian Murphy, right, for the movie.
I told you guys, right?
Yeah. So Prashant is really vindicated, you know. I think you watched the movie 4 times.
3, I think. Yeah.
Wow.
9 hours.
It was worth it. It was worth it. Yeah. And there's one person who can say, I told you so. But the Oscars are on and we'll continue to get you updates on who the winners are. For now, the one winner that we can hear of is Cillian Murphy, Best Actor for Oppenheimer, and Christopher Nolan for directing the film. But more on that in a bit through the course of the day, actually. Let's kickstart the show. On the equities front, you have Sanjeev Prasad of Kotak Institutional Equities, who says the broad-based rally in PSU stocks is largely driven by top-down bullish sentiment for PSUs in general, rather than any major bottom-up structural fundamental developments. They see several problems with the euphoric sentiment for PSU stocks. First, bullish short-term profitability and volume assumptions. Second, incorrect valuation methodologies. And third, unrealistic narratives. He adds several PSUs are trading at absurd valuations. The fact is they're trading at, FACT is trading at 126 times FY24 estimated EPS. Hindustan Copper is trading at 119 times FY24. And IRFC is trading at 3.8 times FY24 estimated book value. So his basic point is that, be cautious in PSUs.
Well, that's Sanjeev Prasad for you. We'll get you some money market views as well. B. Prasanna of ICICI Bank says that the dollar softened as February US jobs data, along with earlier month revisions, indicated an ongoing rebalancing of the job market in the US. He says a softer dollar and seasonal flows helped the rupee perform better, and a sharp appreciation was countered by RBI intervention. For the week, he says currencies will take cues from February inflation data, and he expects the rupee to trade between $82.6 to $83 on the currency. Yeah.
All right, and on the bonds, V. Prasanna says the global yields continue drifting lower on the back of softer economic prints and in-line payroll data. Back home, he says strong investor demand and easing liquidity led the positive momentum going. He says with inflation release due this week, he expects markets to trade cautiously, with the 10-year benchmark bond yield likely to trade in a range of 7 to 7.08%.
All right, we got a lot of stock-specific action track for you. Get to that in just a bit in our special Top 10 segment. For the time being, we run you through the list. We're looking at IIFL Finance, Life Insurers, DB Realty, Torrent Power, Dwarkesh Sugar, and HG Infra. All of them will be reacting to positive news flow. While on the flip side, you have the Tata Group stocks, IndiGlobe Aviation, JM Financial, and Zee Entertainment. All of them will be reacting to negative news flow.
Ed Yardeni is with us, President at Yardeni Research. Ed, good morning. Good to have you with us here, as always, on the program. All is well, Ed? I mean, we saw a bit of a reversal on Friday in the US, right? I mean, the headline was strong, and then everyone thought the detail was weaker. So which one is it, and what did you make of it?
Well, I think the economy is fine. The labor market's still quite tight. There's still plenty of job openings. I think the weakness in the stock market really was more of a technical development. We've had a huge run-up on semiconductor stocks, and they were due for a bit of a correction. And we saw that NVIDIA was down by over 5%. Some technology companies, some semiconductor companies mentioned that things weren't as spectacular as they seem to be for NVIDIA. But I think there was simply some profit-taking at the end of the week. Meanwhile, in a couple of weeks, we're going to have in San Jose, California, a big festival sponsored by NVIDIA to show off everything that artificial intelligence might be able to do. So I don't see this market really selling off much more in the face of what will probably be a fairly exciting convention by NVIDIA.
Yeah, okay, that's going to be an interesting one, right? But how are you feeling about emerging markets like India now, Ed? Because the going has been good so far, but at the moment we're also seeing some signs of correction in the broader markets, the mid and small caps. Would you be cautious, after the run-up that we've seen?
Sure. Yeah, I think India's had an extraordinary run, and some profit taking there is probably advisable. But I think the long-term prospects remain quite bright for India. You know, I think when you look at emerging markets, when global investors look at emerging markets, they realize that China is in a recession. I know their data doesn't necessarily confirm that, but certainly the weakness in their stock market over the past couple of years, the government's attempt to stabilize the economy and particularly the stock market, all suggest that the property market bust really is depressing China. And in turn, that's depressing global commodity prices, which isn't very good for countries like Brazil. On the other hand, countries that import commodities like India get a benefit from all that. So I think that's been another reason why India's outperformed. China would have done fine if it wasn't for the fact that they've got a property bubble that's burst.
Hi, Ed. Good morning. Good to see you. And, on the S&P 500 from the October lows, I think that market's up 1,000 points. And you have told us in the past you expected to go to around that 5,400 odd mark. So the global setup looks pretty okay, going by what you're telling us. But for India and for other emerging markets, the dollar index is going to be crucial as well. And that's cooled off a little bit. It gave us that feeling that maybe it's going to go past the 105 level. It's cooled off to around 102.5, which is great news. How do you see that one behaving?
Well, I think a lot is going to be determined by the market's perception of what the Federal Reserve is going to do. And I think there's still an expectation, especially after Powell's testimony in Congress, that he said that, we're not far off from lowering interest rates. That seems to be the story he's telling. I think that they are actually going to turn out to be so much further off than Powell was indicating. I think they have to be concerned about speculative excesses in the financial markets. And if the economy continues to do well, all that really means that the unemployment rate stays below 4%, and it's been below 4% for 25 months in a row now, and inflation continues to come down. Why mess with success? Why lower interest rates? Why rush to do that? And I think there's going to be some pushback from some of the other members of the Federal Open Market Committee, and I think there'll be. I don't expect to see more than 2 rate cuts later this year, and there's a case to be made for no rate cuts at all. If that's the case, then the dollar's not going down.
So case to be made for no rate cuts at all as well, and you don't see more than 2 rate cuts this year. So just to summarize, when it comes to the Indian markets, you continue to be bullish. You don't believe that there is any major correction coming through anytime soon, right? This could be a stable up move that could continue despite having big events like the elections upon us.
Well, I'll be honest with you. I'm not great at calling corrections. I think it's a tough game to play, and if you call it well and call the top, you also have to call the bottom in a correction. And people who get top sometimes forget to tell you to get back in. I think you stay with the market. I think you invest in good quality names. I think broadening out to some of the mid-cap, smaller and mid-cap stocks makes sense in the Indian market. The Indian market's very reminiscent, similar to what we're seeing in the United States. A very strong bull market led by a few stocks. And then at some point, the market broadens out, which I think both markets are starting to do.
All right, we'll leave it at that, Ed. Thanks a lot for joining in. Appreciate your thoughts. Let's take a quick break on that note. On the other side of the break, our entire team will be with us to help us with a list of top 10 stocks. Stay tuned. Welcome back. Our entire research team is standing by to help you with the list of top 10 stocks for the day. First up, there's a lot of action happening at Indigo's end. So Sudarshan is here to tell us why you should keep that stock on your radar. Sudarshan, good morning.
Good morning, Sonia. So, as per the term sheet that CNBC TV18 has an access to, in this tranche, promoter Rakesh Gangwal is looking to sell up to 5.8% stake to raise almost rupees 6,600 crore. Earlier, it was announced that he'll be selling 3.3% equity, but later it was raised to 5.8%. And the floor price for the same is rupees 2,925 per share, which indicates 6% discount to Thursday's closing price. post this stake sale, Rakesh Gangwal's holding will come below 20%, and as of December 2023, his holding was 25%. Talking about the stock performance, on Thursday, it was up more than 1%, and from 52-week high that it had hit in February, it's down nearly 6%. So I expect stock to start with the red, considering quantum of the stake sale.
All right, thanks a lot for that. Well, let's hop across to Abhishek now. He's tracking JM Financial and IIFL Finance, which has been in the news last week as well. Abhishek, good morning.
Good morning, Sonia. So to begin with JM Financial, SEBI has put restrictions on JM Financial with respect to the debt issue or debt part of their business. So they have barred JM Financial from taking any new, debt public issue mandate which they do in their regular course of business. They may continue to manage the existing debt for another 60 days. And SEBI will complete an investigation on JM Financial with respect to a time frame of 6 months. IIFL Finance, they are to consider fund issue on 13th March. They will be holding a board meeting over there. They may do it via equity issue or convertible bonds, debentures or any other instruments. And the options are also plenty with respect to rights issue, private placement, preferential issue or any other method. Just to alert our viewers, last week, Fairfax had agreed to invest up to 200 million into the entity. And earlier, RBI had put restrictions on its gold financing business. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's hop across to Yash. He's tracking the life insurance companies closer. Hi, Yash. Morning.
Good morning, Nigel. So, of course, it's a favorable base which the life insurance companies were working on, but the numbers for the month of February have been pretty strong. As far as HDFC Life is concerned, the premium for the company after 2 months of slow growth has grown in the month of February at 14%. The fourth quarter and up to the month of February, total AP is up 16%. Retail AP in the month of February growing at 28%. ICICI Prudential Life Insurance, again, a very strong growth for the company. February premium up 33%. January and February AP put together has grown at 19%, and February retail AP is up 34%. Max Life Insurance has been the strongest performer as far as the month of February is concerned. So Feb premium up 51%, Jan Feb AP up 44%, and February retail AP up 34%. SBI Life Insurance, again strong growth, February premium up 32%, Jan Feb AP up 30%, February retail AP up 26%. Finally, LIC February premium up 67%, Jan and Feb AP put together has gained 32%, and February retail AP growing by 13%. The stocks haven't moved in the last 3 months in this quarter so far, and these numbers will certainly support the stock price.
All right, Yash, thanks very much for that. Now, one of the big stars of last week was Tata Chemicals. The stock had rallied 40% if you take the change over the last 6 days or so. On your screen, 39 point something. So a big move, right? And Thursday was no different as well. The reason which was cited for this move was a report from Spark Capital, which suggested that the value of Tata Chemicals' holding in Tata Sons was responsible 6 days back for some 80% of Tata Chemicals' market cap, basically suggesting that the intrinsic underlying business was coming to you very cheap. I'd highlighted this on Friday on Editors Roundtable, where I looked at the latest numbers as of Friday after the 40% rally, and guess what? Tata Chemicals' FY25 price to earnings ratio had moved up to nearly 18 times from around 12 times where it was 5 or 6 days back. Why was the market focused on Tata Sons? Just to give you some context, well, that is because Tata Sons is classified as an upper layer NBFC. RBI had done so in September of 2022, and this basically meant that from the date of notification, Tata Sons had to list within 3 years, that is by September of 2025, basically a year and a half from today, from now. Now, the latest, right, the news, we learn from sources that Tata Sons listing in the foreseeable future is unlikely. Tata Sons is considering multiple options to comply with RBI's upper tier NBFC rules. And these options could include trying to reduce debt, and of course also hiving off Tata Capital, which could be considered. Tata Sons offered no comment when we reached out to them for a response to our story. For the Tata Chemicals stock, where this essentially was cited as a reason, this of course is clearly a negative from a price action perspective. Guys.
All right. Well, that is on the Tata Group. But let's go back to Sudarshan. He's tracking a couple of other names, DB Realty and Z Entertainment. Sudarshan, over to you.
So first I'll start with DB Realty. It has launched QIP to raise funds, and sources say total size of the QIP is rupees 1500 crore and indicative price is rupees 258 per share, which is at a discount of 8% to Thursday's closing price. And equity dilution due to this QIP is likely at 10.4%, and companies plan to use QIP proceeds for business development and loan repayment. Z Entertainment, Rahul Johri has resigned at President Business South Asia, and this resignation was effective March 8.
Okay, all right. Thanks a lot for that, Sudarshan. And well, let's wind this down with Vivek, who's joining in to tell us some more stocks that are in the news. Morning, Vivek.
Well, good morning. Few stocks in focus on the back of order wins, etc., that have come in post-market hours. So first on our list is Torrent Power. The company has received the letter of award. Now this is for supply of solar power, and the total capacity would be over 300 megawatts. This particular award has been received from the Maharashtra State Electricity Discom, and this is under the PM Kusum scheme. Estimated cost is 1,540 crore. The tariff is 3.1 per unit. Now, when you're talking about Dwarikesh Sugar, expect some momentum in the stock today. On the positive side, the company has approved the buyback of 1.6% of the total equity, buyback price at 105 rupees a share, and the total buyback will be done via the tender route, and it is up to 31.5 crores. The next stock on the radar, HG Infra, the company received two orders, or it emerged as lowest bidder in two orders. The first one, L1 for construction of 4-lane elevated corridor. Now this is in NH33 in Jharkhand. Total time period for this particular order is 30 months, and the size of the order is 610 crore. The second order is for a TN, that is Tamil Nadu Andhra Pradesh order, highway construction project. The company has given a total bid cost of over 860 crore. So with that, the total order info for HG Infra in YTD FY24 stands at over 3,000 crore.
All right, thanks a lot for that. Here's a quick recap of our top stocks with positive news flow. There's IIFL Finance, life insurer companies, DB Realty, Torrent Power, Dwarikesh Sugar and HG Infra. While stocks with negative news flow, Tata Group stocks, Interglobe Aviation, JM Financial and Z Entertainment. But let's also get a quick lowdown on what's happening in the world of commodities, shall we? Manisha Gupta joins in for a roundup of all the action there. Manisha, hi, good morning.
Morning, Sonia, and thank you for that. Well, it's an all-time high yet again, another day for gold, where we are now above $2,180 an ounce. It has been hitting record highs for the last 8 trading sessions now. The U.S. non-farm payroll data is higher than expected, but the rise in unemployment and deceleration in wage growth has been supportive for gold. Also, the dollar index is trading at an 8-week low, and that has been supportive for gold, silver, and many of these other metals as well, which have started Asia on a positive note. What is not doing so great is the crude oil price is extending loss from the previous week. There has been weak demand from China. The U.S. driving season is yet to start. And OPEC and allies, even as they have been talking about cutting output, the month of Feb actually has seen higher output as compared to December and Jan as well. And that is what's weighing onto the market.
All right. Manisha, thanks very much for that. So that's commodities and oil specifically in focus. But what are the top brokerage calls this morning? Sudarshan has gone through the list, and he's getting us the best and the biggest ones. So, morning, back to you again.
Morning, Prashant. So I'll start with CLS on HDFC Bank. It has downgraded the stock to outperform from buy, and target is cut to 1650 from rupees 2050 per share. It says challenge on deposit accretion to manifest in lower loan growth, and companies facing twin challenges on deposits, high ask rate and a tough environment. It says NIM recovery will be more U-shaped than V-shaped, and it trims FY25-26 EPS estimates by 5%. Next is Jefferies on LTI Mindtree. It has a buy rating, but target is cut to 5,890 per share. It says resignation of CFO with other senior level exits suggest integration issues, and it says company may take longer to realize revenue synergies from the merger, and due to this, it has cut estimates by 5 to 9% and expects company to deliver 15% EPS CAGR in FY24-26. Last is Antique on BHEL. It has a buy rating and target is raised to 299 per share. It says company has reported robust order inflow in FY24 of 36,000 crore and had estimated a 4 gigawatt of thermal ordering in FY24, but it has already received 6.5 gigawatt of thermal orders till date, and it expects company to witness a meaningful reverse in ordering inflow over next 3 to 4 years.
All right, thanks a lot for that, Sudarshan. So that is the list of brokerages for the day. Let's take a short break. On the other side, Prakash Diwan will join in for some fundamental stock analysis. Do stay tuned in for that.
Welcome back to Bazaar Morning Call. Well, plenty to discuss in terms of stocks that are going to be moving around today. And we have Prakash Diwan who joins us for just that. Hi, Prakash. Good morning. Good to see you in. Prakash, I was traveling over the weekend and airports are full. I believe that even room rates are moving up. So this travel and leisure space clearly isn't done. What about Interglobe? That's going to be a large trade that takes place today where the promoter entity will be selling a little bit. The street was anticipating this. But your view on the stock?
Good morning, Nigel. So I absolutely corroborate with this view that this is a space that is likely to see continued consumption, trends which are positive. Intergroup particularly, has gained so much of market share, so much of heft in the last year or so, in spite of the fact that we thought Air India and Vistara and Air Asia would all kind of converge to give it, tough competition. But I think their ability to be able to fill the right kind of pockets in terms of vacant slots which are there, the kind of routes that the sectors that they've chosen, and the way they've kind of priced themselves, they are a bit expensive, but not too expensive to hurt, but absolutely in a profitable zone. So my sense is the numbers which come through in March will be absolutely very encouraging. This particular stake sale from one of the co-promoters is essentially an overhang which should go as quickly as possible. Once that happens, it'll be very interesting to see what the Gangwal family does with a lot of this money that's coming through, whether there's speculation that they could probably start feeding that into another competitor airline. But we'll leave that for another day. But on Interglobe, I think the numbers, the RASK, everything is looking very promising. And my sense is that after this overhang is out of the way, you'll probably see a little bit of resumption of buying for the next leg of the journey of the stock. So quite positive on it. It could surprise you with some very sterling performance even going forward.
Okay, that's interesting. The other space that will be in focus this morning, Prakash, is the insurance companies, right? Strong data coming through in February, whether you look at Max Life, where premiums have gone up 51%, SBI Life premium is up 32%, ICICI Pru is very strong as well, 33%. In general, how do you feel about this space? And from a retail investor's perspective, do you think there's more upside?
Good morning, Sonia. So you're right. The numbers tell you that every time there is a little bit of a softness in the insurance stocks, go ahead and just buy that, because they willy-nilly they end up kind of relying on their distribution strength, and all of these, by the way, have immense tailwind from the bank assurance machinery chugging, including Max, which was probably missing, but with Axis coming into the picture, it's a very different story. So very clearly, some of these three, four players which are largely bank assurance driven will continue to grow, because not just awareness, but the kind of digital reach that they have created. And I can tell you, I've seen people availing of insurance who always wanted to, but they didn't know how to enable that. But that's changing so dramatically. I'm quite positive that they will have growth rates which are superior to the industry or the entire segment. But you need to buy these when there is some sort of a news flow which starts giving you those at some sort of a softness. But at this point in time, also, the risk reward is quite favorable for a market outperformance. I mean, don't expect blockbuster returns, but then, today we are in a scenario where even market outperformance is seemingly a good enough target. So from that perspective, it's good. And of course, these are run by very strong DNA, organizations. You really don't have to worry about the flip-flops on a quarter-on-quarter basis. Look at it from a multi-year perspective.
Prakash, hi, good morning. The Tata Group companies, right? There's enough tailwind in terms of fundamental triggers, but the latest for the Tata Chemicals 40% move was that a story which comes back every few years. Tata Sons is listing and, what it's worth, a stake is going to be worth, etc. We, of course, we just put out something that it's in the foreseeable future, it's unlikely. A listing is unlikely. They'll try to avoid it. And they'll try and seek ways to do that. If this entire recent rally, last 5-6 days, and of course on Thursday, all Tata Group stocks rallied. You think there is a bit of a reversal at hand?
Good morning, Prashant. Possibly, because this move in the last week or so, and if you look at post the numbers that Tata Chemicals clocked, the earnings released, it actually fell from, because the numbers are fairly soft, because, the soda ash, caustic soda space is not something which is really in the best of health. And their ability to go into the newer businesses is still kind of taking time. While they have great, presence, 13 of units overseas, they're doing a lot on battery fluids and all of that. But all of that is still in the works. It's not yet started looking commercially very, very positive as yet. But this move of 35-40% of the last 15 days was probably a re-rating of sorts because it was bashed out and this. And it's, let me tell you, Tata Chemicals will always be available at softer valuations. So from a value perspective, you have a very good risk reward when the PE multiple comes down. Because right now it's shot up, because the stock has shot up 40% in the last 2 weeks or so. But this news is something which you can't rely on in terms of, adding it to the portfolio. So if there's a softness, it goes back to the 1,000, 1,100 zones. There you have a very good opportunity to build it into your portfolio for the change in the fundamentals of the business and the business model itself. So I would rather look at that. But yeah, the reversal probably seems imminent. I'm not too sure of what Tata Sons announces or decides to do about this IPO potential. But, there looks like a little bit of too much of optimism built into that news flow.
Okay, all right. Prakash, I think you're still in Goa, right, Prakash?
Yes. So that's why, those expensive fares and room rates don't really bother me, Nigel. So you're welcome to join here.
No, I was there actually over the weekend, but a very short trip with the kids. So in Goa, I don't think you want to go and watch too many movies. But I wanted to ask you about PVR, because Goa was really beautiful, Prakash. I just loved it. To get the kids out of the beach was a task in itself. But be that as it may, I wanted to ask you about PVR. That's been one of the big underperformers. It's corrected from around that 1,900 rupees to around 1,350. But at around 1,350, which is one of the crucial support levels, we're seeing some kind of buying. There were a couple of releases that are lined up, but otherwise no big release, maybe for the next quarter as well. Valuation-wise, though, I think it's trading at less than 10 times EV upon EBITDA. Your view on it?
So interesting that you picked this because, over the weekend I was discussing this with somebody who tracks it very closely and understands the business far more than I do. And the view that I could summarize out of that was that, at this valuation of less than 10 EV by EBITDA, it's very clear that you are valuing the screens at a level which is probably not too far off from the lowest bands that we saw. There were a lot of screens that change hands at about 12 crores in the past, cinemas which got sold out to a lot of these multiplexes. Right now, from the number of screens that they have, 1,700 or whatever, it's not something which is very expensive from that perspective. I agree, Nigel. But the challenge here seems to be an assurance of footfall. What's happening is while you're competing with OTT to get people into cinema halls through the door, it's also the creativity of the industry, which is not something which is very foreseeable, in the sense very certain or predictable. So if that doesn't kind of give you some sort of a semblance of visibility, it's very difficult to figure out how, the next quarter, 4 quarters is going to go. So it's a great franchise. After the merger, it almost sits on a very monopolistic kind of a dominance in the business. So if the sector does well, it actually rides well. But when the sector turns around is a question that I don't have an answer to. So I would look at something far safer, boring, and not very uncertain in that sense. But yeah, I do agree it's kind of bottoming out. So for people who have the long-term view and the patience to hold on, it could offer an opportunity. But I don't have a very constructive view at this point.
Okay, not a very constructive view on PVR Inox. Got that. I wanted your thoughts on HDFC Bank because CLSA has downgraded the stock this morning and they've cut their target price to 1650 from 2050 earlier. They still haven't outperformed, but they've downgraded it from a buy. What do you do? As an investor of HDFC Bank now.
So Sonia, if you look at this downgrade and the revision in price objectives, 2050, which were the earlier price objectives, seems to have, they probably have forgotten to downgrade it too soon. And even at 1650, it gives you an upside of $200 from where the stock is. So from that perspective, what they're saying is it will do well from where it is, but not as well as what we anticipated. So that's absolutely par for the course. What does an investor do? While the legacy is absolutely formidable and strong, the bank needs to reinvent itself because it has morphed into a very different organization, right? After the merger. So people will have to give it time to bring back all that salience in this merged form, and with so many different customer bases and so many different product bases. And that reset will take some time. It's not so easy for elephants to dance so easily. My sense is you'll have to give them at least 2 quarters, and then the numbers look up. And by the way, the data that's come through RBI's reports on the first 15 days of March or even February, the deposit growth rates have been very, very weak. So what's happening is a lot of the deposit buildup which was happening across the sector is not taking shape as much as you would want an HDFC Bank to benefit. So they'll probably invest this energies into setting up branches, doing whatever they can to expand the base. I keep getting calls from HDFC Bank being a customer for fixed deposits so very often in the last 3 months. I've never had that in the last 20 years. So, it's very clearly an aggression that they are getting back, but it will take some time. Once all that reset happens on those ratios, 110 CD ratios and all that, will have to start normalizing. It'll happen. But look at some of these banks, the other private sector banks, they might probably start doing better towards March end once things look up. But HDFC, you'll have to an investor, you just have to be patient. Don't get greedy and keep buying at lower levels, because you'll have a time correction, if not a price correction, which could last almost a year.
Already happened, right? That time correction. I mean, this year, in the last 1 year, the stock has done nothing. Let's do one thing. Let's take a quick commercial break. On the other side of the break, Anuj will be with us for a quick trade setup. Post that, we'll bring you the top stock picks for the day from our technical and F&O experts. Stay tuned.
Okay, welcome back. You're with us here on Bazaar Morning Call. There's a few minutes to go for the pre-open session, but Anuj is here with what he's making of the market, the setup. Anuj, morning.
Morning, Prashant. There's this movie coming up, right? Bade Miyan, Chote Miyan. It's like that playing out in the market right now. Large caps versus mid caps. This month, the Nifty is up 2.5%. The mid cap is up only 1.3%, and small cap is actually down. Small cap is down 1.7%. So it tells you that there's been a bit of a distribution phase. It's been on for some time. In fact, better part of last 1 month, we've seen that the market breadth has been extremely poor, except for Thursday when it was actually quite okay. So as I said, some distribution phase. Normally, a distribution phase is then followed by a correction. So let's see if that happens or not, and whether that coincides with the election announcement, which we're expecting, I think, on Thursday. So let's see, large caps offer a better risk reward right now. I want to point out a couple of things in trade setup. One is FIs and index futures. We're once again approaching that even zone. After Thursday's short covering of 15,000 shorts, we are now at 58% short positions. Also, the India VIX is now reaching complacency zone once again. The India VIX is down 5%. And the put-call ratio has been elevated at around 1.27, thereabouts. So there are some signs that the market might be slightly elevated. Now, in terms of levels to watch on the Nifty, the first resistance is 22,625, weekly options data-based, and the bigger resistance is 23,084, monthly options-based. Again, on the Nifty, there's no problem. Support lies in at 22,430 and then 22,224. I think the bank Nifty is the one which has been trying to catch up for some time now. This month, it's up 3.7%. And there's a likelihood that it perhaps at some point tests its all-time high as well, which is about 1.5% away. The resistance comes in at, the support first, 47,650 to 47,750, and then 47,200 to 47,400. And on the upside, the resistance comes in at 48,100 to 48,200, and then 48,500 to 48,600. Lot would also depend on HDFC Bank, because once again, that started to show some kind of bargain buying. So let's see if that sustains or not.
Okay, thanks a lot for that. Important to point that out, that there is a shift that we're seeing away from mid and small caps back to large caps. So prudent to be a bit cautious in the broader markets, perhaps. Let's get it straight to Mitesh Thakkar and Sudarshan Sukhani to find out whether they concur with this view. Mitesh, hi, good morning. First to you, are you a bit cautious? Okay, Sudarshan is actually with us, so let me go to him. Sudarshan, good morning. Are you a bit cautious in the broader markets now? And do you think it would be prudent to stick to large caps versus mid and small caps?
Yeah, good morning. Yes. As far as the broader market is concerned, the small caps and mid caps are probably suggesting that a long phase of consolidation is coming for them. So inside this consolidation, it will become difficult to actually identify stocks that are going to move up. They'll probably be in a range. So it's best to hold your stocks, whatever you own, but new buying is not a good idea there. Large cap stocks, as we can see in the Nifty, continue to rally, and they usually outperform when the mid caps are sometimes in consolidation. So stay with large cap stocks. The Nifty itself continues to suggest higher levels. Just for today, we are seeing a narrow range develop on Thursday. So that probably suggests that we'll see some choppiness. Inside this choppiness, the trade for the Nifty and the Bank Nifty both is to look for a dip and buy that dip. The trend still remains clearly up.
Okay, all right, trend is up. So noted that, Sudarshan. Mitesh, coming across to you as well. What's your view on the index? What are the levels you're looking at?
I'm actually, maintaining a positive bias. Last couple of days, we had some volatility, and we actually saw the Nifty decline to support levels of 22,250, 22,220 zone. I think as long as that is not violated or breached, my sense remains that we will see 22,600 plus levels shortly, and then maybe even 22,850. So, in that sense, maintaining a positive bias. And I would also agree with Sudarshan. I think the idea is that now it looks like that large caps will possibly cover up for some of the underperformance. Plus, there are profit booking signs in the mid cap and the small cap stocks. So I think it's a good idea to trade and find your focus in large cap stocks.
Okay, so let's take it straight to individual stocks then. Sudarshan, what would your list look like this morning?
Well, Voltas is a buying opportunity. The stock had a decent rally. It's now come down to a small minor correction and a support level. Buy with a stop under 1060. UBL is my only short. It's an intraday short. Stocks should never be carried. Short selling should not be done on a carry forward basis. Sell UBL with a stop above 1720. Trend is a buy. A nice small consolidation suggests is willing to go higher. Stop is 3880 and consider buying it. And finally, ITC, which had that mini bear market decline, is now in a trading range. It does suggest that it's willing to now break out and continue its up move from where it left. So buy ITC with a stop under 407.
Got it. Okay, got your picks as well, Sudarshan. Mitesh, what about you? Your picks?
So ITC actually features on my list as well. I think there are good signs of reversals from an oversold level. It could have a good trading rally. I have a stop at 408 and a first target of 425. Eventually, we can even look at 435, 438 levels. Then I have a buy on Glenmark with a stop at 939. Look for targets of 990 here. A buy on SRF with a stop at 2410 for targets of 2530. And BPCL is the solitary sell call, which I would recommend selling with a stop at 638 for a target of 595.
All right. We'll leave it there, gentlemen, but have you back soon again for more in a bit from now. We'll take a quick break here. We are back. We have Basudev Banerjee of ICICI Securities. We put the focus on the auto sector. Stay tuned. That conversation coming up. Okay, welcome back. There's about 3 minutes to go for the pre-open session, and let's just quickly take a look at what the rates are looking like. 72 points higher start is what the GIFT Nifty is indicating as a start. Well, Rajesh Palvia is with us, Vice President, Technical and Derivative Research at Axis Securities. Rajesh, good to have you with us here. Thank you for your time. So just sort of draw the landscape for us. What kind of trades one should look to take now as we start a fresh week, and how are things looking?
Good morning, Prashant. So in previous week, some bit of consolidation we have witnessed. Nifty was shying to cross 22,500. But looking at the overall structure for Nifty as well as for Bank Nifty, we are optimistic and we believe that this upward momentum is likely to continue in current week, and possibly we can cross 22,500 in the continuation of this up move which we are witnessing since last couple of weeks. Overall, structure is bullish. Put writers are aggressive at 22,400, 22,300 strikes. So as we are comfortably holding about 22,400, then possibly one should remain on the long side of trade. So buy on dip should be your strategy to play this move of market. One can look to buy 22,500 strike call option, which was closed at around 116 rupees. So if you get any opportunity to buy this call option around 100 rupees, it's a good level to buy this option. Keep your stop loss at around 65 rupees, and on the higher side, 150 to 160 could be the possible target we can see in coming trading session for 22,500 call option. On the Bank Nifty, almost we are trading near to the major call concentration area of 47,800. If we sustain above those level on Bank Nifty, then possibly we can see a short covering action, and then Bank Nifty can scale up to the next level towards 48,200 to 48,500. So Bank Nifty is also looking promising. So buy on dips should be your strategy in Bank Nifty. Also keep your stop loss at around 47,500. On stocks front, Tata Power is looking very promising, very strong buying action in previous session. Long build-up was there. So we expect Tata Power can exhibit again, really, and we are projecting target towards 445 to 455. Keep your stop loss at 420. The second stock that we like from insurance space, that is ICICI Prudential. In last couple of trading sessions, strong buying action witnessed. Stock managed to be breakout of its previous consolidation range. Looking at overall structure, we believe that ICICI Pru can exhibit good amount of rally towards 605 to 610. So one can look to buy ICICI Pru with stop loss of 568. And the third stock is from fertilizer space, that is Chambal Fertilizer. Most of the agro fertilizer stocks have done well in previous session, and Chambal Fertilizer is looking promising. We expect a stock can rally towards 385 to 390. So one can look to buy this stock with stop loss of 366.
Okay, all right. Thanks a lot for that, Rajesh. By the way, guys, just want to point out one thing. The Nikkei has been the big outperformer, right, in the last 1 year and this year as well. That index actually is down 2.5%. So, surprise, surprise. The big outperforming index, I think, year to date, and even for the past 1 year, which has come out from the slumber as we were talking about. Yeah. Well, that one's seen some profit taking. Currently at the low point of the day, down 2.5%.
Okay, that's a very interesting observation there. But for the market, right, looks like it's going to be a flat opening. We have a couple of stocks that do deserve mention, though. In pre-opening, take a look at HDFC Bank. As we were telling you, CLSA has downgraded HDFC Bank to an outperform from a buy. They've cut their target price to 1650. That stock is under a bit of pressure right now, down about 0.5%. Interglobe Aviation, there's a large block deal expected where Gangwal would be looking to sell about 5.8% stake. Interglobe is down almost about 1%. And then, of course, a lot of these, insurance companies, life insurance companies, Max Life, SBI Life, ICICI Pru Life, good data coming through. So those stocks could be in the green. But a couple of more questions for Prakash Diwan, and then we'll hand it across to, an auto expert on a couple of important updates that have come through. Prakash, I wanted your thoughts on, M&M. I know we've discussed it ad nauseum, but this morning HSBC has raised their target price on M&M, speaking about if M&M went down the same route as Tata Motors and demerged its farm equipment and auto business, it will be big value unlocking for shareholders. Would you concur with that view, and is that the logical progression for the business?
So, we are in a bull market, so the mood is to kind of figure out triggers to push things to the limit. But the demerger for auto business, between the auto and the farm business, would probably be a bit too shallow. I mean, Tata Motors was a different distinct, where the depth that they've created in each of those businesses and the commercial business legacy is very different. I don't think that's the same comparable, metrics that would work so well in favor of M&M. But, never say no, because there's always the possibility of some sort of a synergy emerging out of, this thing demerging as well. While they're together, things could be different. But the best part about M&M is that if things turn around on the farm sector, automatically the stock will get re-rated irrespective of what happens to the demerger, because that's the only lag today they have. Otherwise, if you look at SUV, EVs, a lot of those other pockets that they are focused on too, they're doing extremely well. So I would not get tempted buying into this just because of that. But yes, things do look positive if as I said, the agri sector starts picking up and the vehicle sales start picking up within that sector.
Okay, all right. In the last 6 months, actually, the stock is up over 20%. So let's see what happens from here. In fact, we have an auto analyst joining in. Basudev Banerjee, the auto analyst at ICICI Securities, is with us. Basu, hi, good morning. Same question to you, right? HSBC is very optimistic on the fact that M&M should go ahead and demerge its units into two separate businesses. That will bring a lot of value unlocking for shareholders. But what do you think the upside could be based on some of the part analysis if this does come through? And in general, how are you feeling about M&M?
Sure. So, as you rightly pointed out, that if you look at in last couple of years, what has transformed in this business, one is the auto segment EBIT margin having moved up from 4.5% to current levels of 8.5%, and monthly volumes of SUVs moving up from sub 20,000 to now crossing almost 40,000 at retail level. As a result, the auto segment as a whole is becoming self-sufficient, and the earlier it used to be very much dependent on the cash flows of the steady tractor segment. So from that perspective, where profitability of auto segment is more or less similar to Maruti's level currently, and value proposition in the SUV business for Mahindra is moving up every year. So from that perspective, re-rating of the auto segment independently, plus, as you said, the long expected separation of a tractor business and the rest of auto business, logically it can't be ruled out in the longer run. But currently, these are all just hopes and speculation, nothing material.
Okay, the stock that you like from the auto space is Hero MotoCorp. You have a buy with a target price of 5,000. Now, that stock has had a big rally, right? In the past 6 months, Hero is up 52%. What is the rationale for this buy? And don't you think a lot of the good news is already in the price? Okay, I think we have a little bit of an issue with that video. Go ahead, Basu.
Yeah, so as you rightly pointed out, for Hero, if you look at the two-wheeler peers like TVS or Bajaj Auto, the kind of re-rating they have seen over past 6 months, both are trading almost at 30% premium to their long-term average traded valuations. So from that background, Hero is still very much closer to their long-term average valuation. Forget about a premium. Second thing, Hero has been putting efforts to put their stronghold in the premium two-wheeler space, which they have been lagging for long. So multiple launches at same point of time, Extreme 125, Maverick, X440, all those models, separate distribution center for the premium models. So that effort is getting done.
I can't hear. Okay, I think there's some issue with your audio as well, Basu. So we'll come back to you in a bit. But just wanted to reiterate a couple of the pointers that he made. The recommendations, one is on Mahindra and Mahindra. They have a buy with a target price of 2,100. As he pointed out, the structural growth story is very positive for M&M. And if they go ahead and do what Tata Motors has done, which is demerging their farm and their auto business, that will be a big, big positive. It's not happening anytime soon. It's just a, a hypothetical situation after what Tata Motors went and did. Hero MotoCorp is another buy that they have with a target price of 5,000. But they were reduced on Tata Motors because they say that the stock has already gone up 40% in the past couple of months and the split in the business has already been factored into the stock. But let's give you some more stock ideas, stock information rather. Reema joins in now with today's Momentumizer stock of the day. Reema, morning.
Hi, good morning. So I've got Nelco with me. This is a Tata Group company, and on Thursday the stocks, rose close to about 6.5% on very large volumes. With the up move on Thursday, it even crossed its 200-day moving average. Volumes were nearly 6 times the kind of volumes we typically see, even delivery volumes. But considering that it's a Tata Group stocks and there could be some overhang of the Tata Sons delisting not going through, maybe this stock's momentum breaks today. The stock, remember, is still about 9.5% away from its 52-week high of 893, though the all-time high level on Nelco is much higher at 1,090. Back to you.
Okay, thanks, Reema, for that. Well, the pre-opening rates right now are settling quiet. There's not too much happening on the frontline indices. The mid-caps are actually up in the green, up almost about 0.5%. And a lot of stocks, NLC India, RVNL, a couple of others, Suzlon Energy, seeing little bit of action now this morning. Sudarshan is back with us. Sudarshan, what's the big call at 9:10?
Consider buying ITC with a stop under 407.
ITC. All right, that's your buy call. Mitesh, what about you?
I'll go with a buy on SRF. Recommended stop loss here is roughly about 410 and a price target of around 25.30.
Okay, all right. Just look at the oil market. Just a few names, right, at the end of the pre-open session. IOC, HP, BP. There is the the LPG cylinder prices being brought down by 100 rupees. Maybe take a look at where they are starting at. Slightly down. About IOC is down a third, and I think the others are down a 0.5%, etc. as well. Let's just look at Zomato as well. Over the weekend, there were some reports indicating that you basically had Flipkart, which was coming up with a quick commerce kind of initiative and was pushing into the space in an aggressive way. There is Zomato. And then look at some of the city gas distribution companies, which was, of course, the big story last Thursday. So MGL, IGL, actually, those are the two large ones. Both are actually starting 1/3% higher, 1% on MGL as well. So they saw sharp cuts. But oil and gas is what we are focused on. Sonal is here to tell us about, of course, oil marketing companies, as I was talking about, and GAIL in focus as well. Sonal, hi, morning.
Good morning, Prashant. Let me start with oil marketing companies. As you were mentioning, the government has gone ahead. They've cut LPG cylinder prices by 100 rupees. And important to note that this price cut will be borne by the OMCs and there will be no fiscal impact on the government. What it means is there will be some under recoveries for oil marketing companies, and that is a bit of a negative for them. Citi has put out the number to that. They say this would lead to an under recovery of $100 per ton for OMCs. However, they continue to retain their positive views, and they say that they would use any meaningful pullback as an enhanced buying opportunity. But yes, this news flow is a tad bit negative for oil marketing companies. For GAIL, there was an analyst meet, and most of the analysts went to their Vijaypur plant as well, where they say that the HPG pipeline, it stays within the key national gas grid, which is 60% of the total transmission volumes. However, the capacity utilization there remains low, which is worrying the analysts. GAIL is also setting up green hydrogen plant with capacity of 4.3 tons per day with a capex of 230 crore rupees. This would mean the cost of green hydrogen would be around $2.50 per kg, which would be equivalent to the grey hydrogen. They've also begun blending 2% hydrogen with CNG and 5% with PNG on a pilot basis. So they are taking a lot of steps in the green energy space, which is what the analysts are looking at. I have the ratings coming in from brokerages as well. Nuvama has a hold, Jefferies has an underperform, and CLSA has a sell call and target price ranging anywhere between 150 to 165 rupees a share.
Okay, thanks a lot for that, Sonal. Well, let's hop across to Hormuz to tell us what's Kotak's view on PSUs. Hormuz, morning.
Morning, Nigel. And the big view is that exit PSU stocks because they are finding a lot of issues with the PSU rally that you have had. Now, what Kotak is saying in its note is that the rally is driven by a top-down bullish assumption and that there is no fundamental change that has taken place in these stocks. Now, the euphoria is evident from the fact that in FY24, no PSU has given negative returns. So it shows the kind of moves that we have seen. Now, among the problems that Kotak is highlighting in their note is that bullish short-term profitability and volume assumptions, incorrect valuation methodologies and unrealistic narratives are some of the issues that they are highlighting. Now, they have also spoken about the rally that these PSU stocks have had, and 19 PSU stocks have tripled in FY24. And 28 of them have gained between 100 to 200% during this period. And they have also highlighted that generally it is the low float names that are giving outsized returns. And so the stocks like FACT, Masgao Dock, MRPL with holdings anywhere between 80 to 90% are delivering returns of anywhere between 200 to 400%. So that is the kind of moves that they're seeing. Now, as a result of which they are saying that investors should use these rallies to exit their positions because most of these non-financial stocks are trading at very expensive valuations compared to their private counterparts, and this rally is despite weak fundamentals, weak business models, and what they say is a growing risk of existential irrelevance. Back to you.
Okay, that's interesting. Growing risk of existential irrelevance. Some hard-hitting words there. But just a couple of more stocks, right? M&M, just pull up that stock for you. M&M is up about 1%. Interesting note from HSBC this morning. We just spoke about it a while back. They've raised their target price on M&M to 2,300 from 1,900 earlier. They retain a buy. They've also increased their valuation multiple. The EV to EBITDA, they've increased it to 12 times from 11 times earlier. They say if M&M was to go down the route that Tata Motors has chosen, which is demerge its farm equipment and the passenger vehicle business, there will be significant value unlocking for shareholders, but they'll have to demerge it ideally into 3 companies: farm equipment, auto business, and a holding company for all the listed and unlisted subsidiaries. The upside could be 40% based on the sum of the part analysis that HSBC has done. And they say that, remember, M&M has gained market share across the board in all 3 of its businesses over the last few years. And operationally as well, M&M continues to do well in both the tractors and the SUV space. I just want to reiterate that this is not something that is in the works for now. It's just an assumption that HSBC has made that if they go down this route, it'll be big value adding.
Oh, absolutely. And, we'll keep an eye out on that. I mean, you've got the Nifty, which is going to start about 25 points higher. The pre-open is indicative of that. The Sensex is up about 55 odd points as well. So lots and lots of stocks to track as we begin a new week. And, the Tata Group stocks, I think we'll kind of pay attention to, especially Tata Chemicals out of the sharp rally that we saw on Thursday. But there are many other news-based stocks as well. The first trades are coming up. So it's a slightly lower start on the Sensex. And I think you saw some green for a second and then down 30. The Nifty is down about 5 points or so. So this is as flat as they come on the indices. So you got 22,468 on the Nifty. Bank Nifty is down about 0.25%, 47,719. And you got the Sensex, which is down about 100 points or so as well. Mid-cap index is up a little bit. And I think we'll have the small cap index for you shortly as well. Market breadth is a little over 2:1. But these are, stocks are just opening, so too early. But that's what we have. Absolutely flat right now. Sonia is here with more rates. Sonia.
Oh, thanks a lot for that. So as you rightly pointed out, it's flat for the frontline indices. But if you look at the broader markets, right, that's where a little bit of the pressure is creeping in right now. The Bank Nifty is also down about 110 points, and I think the small cap index is the one that started with a little bit of pressure. Mid cap index is absolutely flat as we speak. Just a couple of stocks to start off with. HDFC Bank, let's take a look at that. CLSA has downgraded HDFC Bank to an outperform from a buy, cut its target price to 1650 from 2050. So that stock is under a bit of pressure. M&M is the other one on the flip side, which is looking good. HSBC has raised the target price on M&M to 2,300 from 1,900 earlier. Interglobe Aviation, that large block deal in the works. Gangwal is looking to sell 5.8% stake. So Interglobe Aviation seeing some pressure there, down almost 1.5%. Insurance companies are also in focus this morning. You have Max Life, SBI Life, ICICI Pru, all reported very strong data, both in terms of the APE growth as well as the premium growth this time. So all the insurance companies should come up for you in a bit. SBI Life is up 1.5%. It has been one of the stronger ones of the lot. And then you have ICICI Pru as well as Max Life that will show up for you in just a bit. So take a look at that. HDFC Life too has been doing well. ICICI Pru is the one that has seen a Feb premium growth of 33%. So I think it's outperforming its peer set. And Max Financial is up almost about 2.5%. So looking good over there. Titagarh Railway is another one I'm looking at. A 1,900 crore order is what it has won from the Railway Ministry. So just look at Titagarh Railway this morning. That one actually has been up and about for a while. Today it's up 6.5% after receiving that fresh order of 1,900 crores from the Railway Ministry. Some of the PSU stocks could perhaps be under pressure this morning as Kotak says exit PSUs after a strong run-up. So we'll watch out for some of these names. But talking about PSUs, RVNL has received a 543 crore LOA from the Madhya Pradesh Metro Rail. So I think RVNL is another stock that is looking pretty good, 7% higher now on RVNL this morning. So a lot of these names, Voltas is also in focus this morning, up almost about 1.5% over there. So a lot of PSU companies that are receiving fresh orders, whether it's RVNL, whether it is Titagarh Railway, all looking pretty good this morning. Back to you.
Okay, all right. Thanks a lot for that, Sonia. Well, just take a look at some of those big movers actually. NLC India, you have that OFS that's in the works. Today is the day when retail can subscribe. The OFS is at a sharp discount in comparison to the CMP, but the institutional cutoff was at around 217 rupees. Explains why there is fair bit of action out there, up close to around 7%. RVNL, as Sonia mentioned, is running away. Dwarkesh Sugar is up close to around 6% odd in today's trade. On the flip side, a few of these Tata Group stocks, they're giving up a goodish bit. Tata Chemicals, now locked, down close to around 10%. Tata Power, down close to around 4.5% as we speak. UCO Bank is another name that's pulled back close to around 5%, and that's coming up as one of the top volume movers that are pulling back. So keep an eye out on that name. Ricoh Auto, actually, it's been in a world of its own. The stock is up close to around 35% in the last 1 month or so. Today as well, up close to around 4%, and coming up as one of the top volume buzzers in trade today. So quite a few movers from the broader markets. HAL add to the list. From the FNO movers, that's up close to around 3% as we speak. Indian Hotels as well, seeing some profit taking now. Been a big move in the last 12-18 months. Today it's down close to around 3%. And that large trade on Interglobe Aviation, that's got done, explains why the stock from being down close to around 4.5%, it's almost moved into the green. Prashant.
Well, market breadth is almost now closing in on 1:1. That's the picture. 1,100 stocks are higher, 1,000 stocks are almost 1,000 stocks are down. So, but it's a vibrant start, right? Look at some of these names. Top of the list, of course, is still RVNL. I think, as Nigel mentioned, HAL is up about 3%. NLC India. So it's all PSUs. The three top volume-led gainers on the NSE are all PSU names. Two are up 6% and HAL is up 2.5%. Max Health is up 3%. Max Health has been recovering, coming off the lows slowly but steadily. The low, of course, last week was, I think, about $700, at about 770 now. The life insurers, ICICI Pru is up another 3.33% or so. Again, ICICI Pru has moved up from about 530 3-4 days back to about 600 plus now. Suzlon reversed after selling off. I mean, it had hit a low of about 37 last week, and it's back at about 42 now, just under 42. Titagarh, I think we mentioned. There is what else? Lodha, that is Macrotech Developers, 7% move on Lodha. It's coming up with large volumes for this point in the day. There is Torrent Power, which is up about 3.33% this morning. So there is, a movement there. Max Financial Services, so these insurance companies, look at GIC, RE, reinsurers as well. They're all looking good. Ethos is another one, which is up about 4.5% right now. By the way, as we speak, market breadth is flipped. But I just want to focus on some stuff on the downside as well. Tata Chemicals, of course, it's down 10. 1183. It rallied from 950. A one-way 40% rally from 950-ish levels. Tata Power will come up. Tata Power was up 8% on Thursday. It's giving back 4% this morning. Tata Consumer also moved. It's down 3% this morning. Rallis India, also a Tata Group company, had a sharp move. That's down 5% this morning. Indian Hotels, again, a Tata Group company, 2.5 lower, 572. Tata Investment Corporation, just a one-way move on Tata Investment Corporation, is one of the big winners of 24, by the way, so far. It's down 5%. I think was up 5% on Thursday. So a lot of these companies are sort of giving back gains that we saw fairly recently. And of course, as Sonal was mentioning, GAIL in news, GAIL is down about 2.5% as well this morning as well. So it's quite, at least on the indices, 9 or 10 points lower is what we have. And market breadth is, flipped into the negative slightly, but it's happened already. Mitesh is with us still. Mitesh, quick view on the open and any trades here?
So no, I'm not taking any index trades, purely because of the fact that it's a very quiet day as of yet. But my belief is that the trend is up. So if we get this dip, kind of goes down to about levels of 22,420, 22,430 zones, then I think, taking a long trade with a stop below 22,390 could be a good idea. Wait for that dip, intraday dip if it happens. Otherwise, just patiently watching the market, seeing if there can be any stocks to be traded on the long side.
All right. Mitesh, we'll come back to you for more a little later. Appreciate you joining in. Hiren Ved is joining us now, Director and Chief Investment Officer, Alchemy Capital Management. Hiren, good morning. Great to have you with us here on the program. Thanks very much. Hiren, let's just start by talking about the PSU call from here. Our colleague Hormuz was summarizing what the folks at Kotak are saying. They're picking out some of these stocks and saying, well, valuations are just absurd now in many pockets. It's obviously one can't make a sweeping generalization, but what are the pockets you like and what are the pockets you'd avoid there?
So I think, PSUs in general have been the leaders of this bull market, right? And obviously one has to be pretty selective, but I think the starting point was two. One is that the valuations relative to everything else in the market were cheap to begin with. And secondly, the largest strategic shareholder, which is the government of India, right? I mean, they have taken several steps across businesses to increase the value of the PSUs. And while I haven't read the entire report, but I think I did see a headline which says that it's all top down. But it has to be top down because, you know, if the largest stakeholder takes broadly all the right calls, then I think what happens initially is that you get a valuation re-rating and then earnings also kick in, right? Again, as you rightly mentioned, I'm not making a case for an unbridled across-the-board rally in all PSUs like we have seen. But I think there is merit in a few select PSUs where I do think that the trajectory of business has substantially changed, especially if you look at the defense pact and the kind of order books that have come, or in some of the power utilities where suddenly power has become a growth sector from a utility sector.
Okay, interesting. By the way, one space that's really surging, and I think Prashant also mentioned it, is the real estate space. Macrotech Developers is now at a fresh high, fresh 52-week high that is. 7.5% rally. It's rallied 23% this year already. Hiren, hi, good morning. There's a lot happening, right? There is this weekend, actually, I had a chance to go on the new Trans Harbour link, the Atal Setu, for the first time. And it is massive, the kind of infrastructure connectivity that we're seeing in Mumbai over the last many weeks and months. But do you think a lot of this is already priced into the Mumbai-based developers? And do you think it's a little risky now to get in? Because valuations also are looking a bit uncomfortable. Your thoughts on the real estate space, specifically the Mumbai-based guys? Now you have Prestige also that's entered this space.
So, Sonia, I think overall, real estate as a sector is likely to do very, very well. Mumbai also, by the way, is one of the largest markets and one of the largest premium markets for real estate in India, along with NCR and Bangalore. But I think Bombay and Delhi in that way stand out because the propensity to buy premium real estate is unparalleled in these two cities, right? I think I wouldn't, again, one has to be selective, but I think the real estate sector has a long, long way to go, in my view. There will be intermittent bouts of correction and consolidation, but we continue to be very, very bullish on if you're asking me Mumbai real estate, I think real estate in general, we are very positive. But I think even Mumbai real estate will continue to do quite well, even from here.
Okay, Mumbai real estate. All right. Hi, Ren. Good to see you in. I wanted to ask you about what's your view with regard to this entire aviation space? We had a large trade that took place on Interglobe Aviation a few minutes ago. More than 5% equity changes hands. The stock was down 4.5%. The kind of appetite we're seeing, stocks moved into the green. So, we know about the rising airfares, leisure travel as well. How would you approach this space? There are only two options. One is SpiceJet, which has been a big drag, but now they've got some funding. They're trying to turn things around. And there's Interglobe Aviation, which has been the leader of the pack.
So, Nigel, frankly, we haven't looked at aviation, as an investment opportunity. Obviously, the choices are very limited. In fact, at this point in time, there's only one carrier that you can really bet on. But I think it's very symptomatic of the point that tourism as a whole is booming in this country, right? And I think there are several ways to play it. One is to play it through the hotel and the hospitality sector. But obviously, airlines is another way to play it. And at this point in time, there is really very little choice other than Indigo. We find it very difficult, because, again, airlines have done phenomenally well. But we've tried to play this theme more through hotels rather than through aviation.
Okay. And what would the pick be out there?
Well, all the hotel chains seem to be good, but I think our exposure is to Indian hotels.
Okay, the exposures to Indian hotels. The other stock that we have to look at this morning is Trent. Just look at the way it's zooming. A fresh high on Trent this morning, 6% higher if you can just pull up that stock. And you know, it's had a dream run. I mean, this year Trent is up almost about, what, 40%? If you can just look at this, just look at the way it's booming now. In the 6 months, it's doubled the stock. You know, this is a success story in affordable fashion, right? I mean, if you look at what Zudio has done in the last 6 months, Hiren, it's given stiff competition to almost all regional retailers, whether it's V-Mart, whether it's Style Bazaar, V2 Retail, whatever, right? And it's also come into its own in terms of an affordable fashion strong brand. But from a stock market angle, from a retail investor's perspective, do you think one has missed the bus on this one, or do you think that it's a long-term structural story?
I think organized retailing in India is still very, very young. You know, there is significant opportunity for growth. Obviously, Trent has literally out-executed everybody in this space, and the market's rewarding Trent for that. But I think that the runway for Zudio and other formats is still significantly large given the size and scale of our country. Very few, apparel retailers have really hit it big in that sweet value spot, right? I mean, the low ticket consumption in India has been struggling, but I think the value fashion segment that Trent has executed via the Zudio format, I think has been extremely successful. And, one should not forget, but, especially the kind of focus, retailing is an extremely focus-oriented business, right? Margins are very thin and execution has to be top class. And I think it's in a very difficult industry. Trent clearly stands out. And unfortunately, there aren't too many companies in this sector which have executed the way Trent is executed. So, I mean, I can't advise your retail investors, but all I can say is that the runway for growth is still significantly long for a company like Trent.
Okay, the runway for growth is significantly long. Just wanted to point out a couple of more stocks before we move on. Blue Star, by the way, is at a fresh 52-week high as well. It's been a very strong mover. This year, Blue Star is up 40%. And there are a couple of new launches as well. We'll talk about that in a bit. By the way, I want to also talk about gold, right? I mean, 8 straight trading sessions, gold has been hitting record highs. And the gold ETFs are performing very well, whether it's the Axis Gold ETF, the Birla Sun Life Gold ETF, all of that performing very well. Hiren, just before we let you go, a lot of the other asset classes are also coming back in a big way. While equities is sort of moving to the, to the sidelines, you have gold that's hitting fresh highs. You have Bitcoin. I mean, cryptocurrencies are coming back in a big way. Real estate is doing well. What should the best asset allocation strategy be for the rest of the year?
Sonia, my asset allocation is all equities, but I think this is one of those rare phases that we are seeing, the sort of Goldilocks kind of scenario where all asset classes are going up. It also, to some extent, reflects the risk on globally. I think, again, I'm not an expert on other asset classes, but I think people should diversify across asset classes. Having said that, I think from an equities perspective, we wouldn't have asked for a better setting where earnings are strong, liquidity is still reasonably good, and I think we are seeing a structural move in equities, and I think we're at least the price action in most other asset classes also looks like to be quite secular from here onwards.
Okay, all right. We'll leave it at that, Hiren. Have a great week. Thanks a lot for joining in. And since we were mentioning Blue Star a while back, hitting a fresh 52-week high, let's talk about that company now. They've launched a new range of over 100 affordable and premium models of room ACs. And given the way the weather is going, looks like it's going to be a really hot summer for many of us, at least living in metros. The company says that they are witnessing significant demand in the room AC market. To discuss more on this development and the business outlook, B. Thiagarajan, the MD of Blue Star, joins us now. Mr. Thiagarajan, good morning, and thanks a lot for being with us on the channel as always. When you say significant demand, can you just quantify it for us? What are the demand trends looking like as we head into summer season? And how do you compare this with what we've seen in, say, the preceding few months?
Good morning, Sonia. It's a pleasure interacting with you. It's a relevant question. Room air conditioners is a seasonal product. All of us are preparing for a great summer season ahead. To put in context, last year, April was good. May, June was a washout due to rains, or what we call as the wet summer. The weather forecasts indicate that this summer season will be a good one. And we anticipate, to put a number as you wanted me to, we think the market will grow by at least 20%. And Blue Star's goal is to grow by 25% in line with our market share enhancement goals.
Okay, so you're saying the market will grow by at least 20% and Blue Star will grow by 25%. What is the time period that you're looking at? Is this for...
I am talking about the summer season, commencing April to June. That is the Q1 of next financial year.
Okay, so you're saying that in Q1 of next financial year, in the summer season, Blue Star will grow 25%. Can you also help us with a full year number for FY25 as a whole? What kind of a top line growth are you looking at, given that your expectation is that this season is going to be so strong?
Yeah, there will be many twists and turns in this, that the summer season is coinciding with the election campaign. And normally we have seen in the past some kind of slowdown. And post the election, we expect the economy to do well. So the festival season should be holding up as it had been this year. The penetration levels are lower, and therefore one would expect the full year growth to be around 15%. And the Blue Star's goal is to grow by at least 20%.
Okay, all right. Hi, good morning, Mr. Thiagarajan, and always good to see you in. I think in the RAC business, your market share is at around 13.5%. And as you've been telling us, in the next year or so, you expect to go to around 15%, right?
That's right.
All right. I want to focus on the commercial AC business. Because there you've seen a sharp jump in the order book, and you've been saying that there is tremendous potential there as well. That's a far smaller market, I think, in comparison to RAC. But if you could tell us what is a rough market share you have out there? And there's an export opportunity as well, I believe, in the CAC market. So tell us more about that.
Thank you, Nigel. Commercial air conditioning market is much smaller compared with residential air conditioning. We will hold close to around 25% market share there overall. But if you are to look at the categories like a chiller or a VRF system, it may be different for different things. Like, for example, it may be around 20% market share in case of VRF. And in a scroll chiller kind of products, we may have close to 35% market share. But that is not relevant. The important thing is that we hold number 2 position in the market. Now, second thing is that this segment has got a lot of potential to grow. Shop, showroom, boutiques, small hotels, large hospitals, and even data centers. So it is a R&D intensive, manufacturing intensive product category, providing much better margins and aftermarket business as well.
Mr. Thiagarajan, hi, good morning. Is this, the end, so for example, one of the areas where there is a large amount of build out expected is data centers across the country. Is that, typically a market that this segment addresses?
Yes.
Is that a growth driver?
Yes. In the electromechanical projects business, as I had mentioned to you in the past, there are 3 distinct categories there. The number 1 is buildings. And the second one is infra projects like airports, metro railway, etc. The third one is factories and data centers. We look at it together. And in data centers, we are a preferred player. We have been doing well. And we are having plans to introduce quite a bit of equipment as well there. For example, chillers which generate chilled water for cooling. And it's a important sector, a growing sector, and we have been doing well.
Okay. Could you talk to us? I mean, we've spoken about sort of growth broadly, the drivers, etc., and some numbers as well for Q1 and the full year. Could you talk to us about margins? And I think that'll, again, go back to what we've discussed in the past, which is the announced capacity additions, competitive intensity, etc. Is everything still on track there? I mean, high competitive intensity, but you've maintained that you'll be able to do well.
The competitive intensity will be very high as we are entering the season. This battle will be bought in number of places. In the showrooms, it will be bought through the in-shop demonstrators. It will be fought through advertising campaigns. While IPL teams may be fighting, the brands fight there for the share of mind. And there will be battles with regard to the distribution penetration in important stores where the numbers are more. It will be a tough market. There is absolutely no doubt about it. We are going by our focus on go ahead and ensure that you have products at all price points. Sonia mentioned about that. We have launched products which are meant for all price points and differentiated products for discerning customers. That has been done. And a lot of money is being pumped into advertising campaigns as well. So going by the past track record, we continue to maintain that for the segment 2, our outlook, what we have indicated earlier, we are still abiding by that, 7.5% to 8%. In the segment 1, it is somewhere around 6.5 to 7%. That we continue to maintain.
Is there scope to increase prices across any of your products over the next couple of months, given that demand is so strong?
I do not think so. Everyone is trying to improve their market share. And I think the pricing will be under pressure.
Oh, okay. Pricing will be under pressure, you're saying, because there is, of course, this competitive intensity and everyone's trying to improve market share. So no scope to increase. Yes, go ahead.
You know, thanks to the PLI scheme, the domestic manufacturing investments had been very high. So when everyone have set up manufacturing capacity, therefore, they would like to gain market share and grow, because the PLI scheme is not, the incentive is not based on production. It is based on the incremental sale over FY21 figures. So it is a sales linked incentive scheme. So specifically in room air conditioners, it will be so. In commercial refrigeration products, we do have scope for improving our margins. Commercial air conditioning, there will be scope.
Yeah.
Okay.
You gave us some numbers, Mr. Tyagarajan. Sorry, you said 7.5 to 8% and segment 1. Could you just tell us? You said there will be pricing pressure, and this in line with what you've talked to us about competitive intensity, etc. Could you guide for the company as a whole?
Company as a whole, it will be at the current level of 6 to 6.5%. And we have been delivering around 5% at the PBT level. And so I do not foresee any major shifts that are going to take place in terms of commodity prices or exchange rates. It can very well take place, but I am making that assumption.
Okay. All right, Mr. Tyagarajan, final question before we let you go. What should your revenue mix look like between RAC and non-RAC? Because there's a lot of focus, a lot of steps you have taken even on the non-RAC business. So what is it now, the revenue composition, and how do you see panning out?
Nigel, it will become selective disclosure. The segment 2, it includes commercial refrigeration products as well as room air conditioners. So I will not be able to deviate from that. So that you can make an assumption that the number of units that is expected to be sold this year is around 10 million units. Blue Star will cross the landmark of around 1 billion units. And we have just done some calculation. In the market, we have so far around 65 million units or 65 million air conditioners are functioning. Now, in value terms, our market share is around 13.75%. You can compute that as well within our segment too. How much is room air conditioners?
Okay. All right, Mr. Tyagarajan, we'll leave it at that. Thanks a lot for joining in and appreciate your thoughts here. So demand is very strong. Summer season is expected to be very good for the industry. A 20% growth is what they're looking at in room ACs. For Blue Star, particularly 25% growth. However, pricing could be under pressure because competitive intensity has picked up. Got that. Let's take a quick break on that note. On the other side, Jasbir Singh of Amber Enterprises will be joining in to talk about their business outlook going forward. Stay tuned.
Welcome back. Well, let's focus on Amber Enterprises. The stock is up close to around 80% the last 1 year or so. Q3 was a weak quarter for them with subdued revenue growth, but they are targeting margin expansion in the coming years, and also they are sounding very, very optimistic on the revenue growth from here on. Mr. Jasbir Singh, the chairman and CEO of the company, joins us on the show. Hi, Mr. Singh. Good morning and thanks so much for joining in. Well, the past quarter was a little bit weakish, but I was looking at your con call and you're guiding for far better times to come in FY25 as well as FY26. Give us a few details. What kind of a revenue growth can you look at? And also segment-wise, how do you see things panning out? Because I'm looking at your breakup, the electronic division as well as the railways and mobility division has been growing at a very fast clip. Please go ahead.
Thank you for having me, show, and good morning. Yes, indeed. We started as a room air conditioner company, and then gradually we diversified into adjacencies, into electronics and railways, and then scaled those verticals up. In electronics, we are very optimistic. We started with PCBA 5 years back with just giving solutions in the space of air conditioners, and then we graduated into refrigerators, washing machine, other consumer durable products, and then we added wearables, we've added telecom, we've added smart meters now, and we've also added auto. And we are just about to get approval from the defense sector also in the electronics PCBA space. So we are quite optimistic, and plus we have acquired Ascent Circuits 60% stake, which strengthens our electronic EMS portfolio for the backward integration. It's a company which delivers complete PCB of applications in various single-sided, double-sided, and multiple-sided and multiple-layer PCBs. Overall, if I see, I think electronic vertical, we have already guided, and I'll repeat it, that we will double our revenues in next 2 financial years. And we are very optimistic for that. Secondly, on the railway front, we've added this vertical by supplying a room air conditioner for railway applications in 2019, and then scaled it up into the metro space, into EV buses, some part of defense applications also. But we were a single product company till now, but now we have added doors and gangways and pantry systems, which has taken our addressable market from 4% bill of material of a passenger car to almost about 10% of a passenger car. And recently we have done a joint venture with Titagarh, where we will be supplying more railway subsystem components to bring up the whole ecosystem of railways.
Right. All right. Mr. Singh, so you have given us a fair bit of detail. Consumer durable is still 72% of your business, but the focus on the other two businesses obviously is going to be increasing, since you're saying that the electronic division is going to double its revenues in the next 2 years. So give us a revenue composition. As of now, the consumer durable is 72%. You have electronic division at around 19-20%, and railways, which is growing very well, that's at around 9%. Say in the next 2 years, going by all that you're saying, you have done some inorganic growth, you're focused a lot on diversifying away from consumer durables. How does the revenue pie shape up?
I think if I see last 4 years journey, we have shifted from room AC. Room AC has come down to 38% in the consolidated revenue, and now it will further come down to 30% in next financial year. And electronics from 19%, it will go to about 25-30% in next 2 years. And railway also will add from FY26 onwards, because we've taken a lot of projects. Order book is very strong. So that will start contributing significantly on the consolidated balance sheet.
Right. So these are all numbers for FY26, Mr. Singh, right? Consumer
That's
durables 30, electronics 25, and there'll be railways which will be chunky as well.
Yeah, I spoke about the range. I mean, it's very difficult to pinpoint a single
No,
number.
absolutely.
But yes, that's true. So we are building these two verticals. I mean, we entered into adjacencies. Now we are scaling them up. And we are optimistic for a good growth in both the segments.
We just had the management of Blue Star earlier with us. I'm sure you heard part of the conversation, and he was talking about competitive intensity in room air conditioners being extremely high, right? Margins, etc., would perhaps be slightly on a slope, on the downward slope, not too sharp, but there is pressure. Will some of these electronics, railways, etc., more than make up for if there is a sharp fall off on the room air conditioner side, sharper than what you think, what you forecast?
Yeah, actually, you see, we are a B2B company. So in a B2B space, especially in the room air conditioners, there has been a structural shift. So first, we were hit by 2 COVID waves in the peak of the season. Then competitive landscape changed. And then finally, most of our customers have started the assembly units, manufacturing air conditioners on their own. So we shifted our strategy into components. And the mix of components, we will be setting off the margin decrease in the finished good versus the increase in this component sector. Plus, electronics and railway application will increase the margin of overall balance sheet.
Okay.
Mr. Singh, sorry, just one more thing. On railways, you said that you are now, your total addressable market is about 10% of a passenger car. You mean a railway coach, right? What is the, in terms of value, what's that number, the TAM on the railway side now that you're targeting?
So on the railway side, one Vande Bharat Express, just for an example, has 16 passenger cars. And in one passenger car, we were addressing earlier just 4%. Now we have moved to 10%. That means we will be addressing about 75 to 80 lakh rupees per passenger car. With the joint venture with Titagarh, now we are building up more component ecosystem. There we will be total addressing about 2 crore to 2.5 crores in a one passenger car. So we are building up many components as a consolidated solution provider for the railway ecosystem. So now you can understand that, there have been railway ministries notification announcements that there will be about 3,000 new Vande Bharat Express plus 25 new cities will be having new metro lines, and existing metro lines are increasing its length. So that means we are talking of almost about 10 to 12 billion worth of the total addressable market for our kind of a components which we will be delivering in next 4 to 5 years.
So that's 10 to 12 billion dollars of an addressable market for your kind of components in the railway system space. I just want to understand what's the order book currently that you have just from railways, and what does that feature in as a percentage of your total order book?
So we have order book of almost about 2,000 crores in our railway segment.
Okay.
And what we have done is basically from room air conditioner. Room air conditioner is about 25 to 28,000 crore market, and on the manufacturing footprint it converts into 17,000 crore. So almost $2 billion. So what we have done is we've increased 2 adjacencies, electronics and railways. So in railways, addressable market for next 4-5 years is about $10 billion. Looking into if all the announcements done by Ministry of Railways are actually implemented. And in electronic EMS, you know that electronics is a big space. Already $118 billion worth of electronics are getting manufactured. But if I speak about TAM of what Amber is delivering, PCBA and PCB, this will be a good addressable market of $25 to $30 billion moving forward in next 5 years.
So you said your order book currently is 2,000 crores, right? What is the order visibility? I understand the addressable market, but over and above this 2,000 crores, what is the order visibility from railways over next 12 to 18 months?
So in 12 to 18 months, like these, all 2,000 crore projects have to be delivered in the next 4 years. And plus, there are additional new tenders which are coming next financial year. So it will keep on rolling on the basis of the announcements done by the Ministry of Railway and Urban Development Ministry for the metro space.
All right. Profitability is something that the street looks forward to, Mr. Singh. So before we let you go, wanted the guidance on that front, because you were guiding that margins, I think, move to around 7.5% in the next year, I think FY25 and FY26. So give us an updated margin guidance, point number one. And you've spent a lot, on capacity expansion, etc. And the street was hoping that the ROCE will start improving to high teens. So what is the guidance there? I think you were talking about 19% in 2026. Please give us a number on both these two, margins and ROCE.
So yes, you're right. Margins, we are looking towards 7.5% moving forward in next financial year. And further, we will be increasing our margins in FY26 also, because our railway order book, which will start delivering, and electronics also, we have started, we will be touching almost about 7.5% or 7 to 7.5%. And on the guidance of ROCE, we have already guided. I'll again repeat that in next 3 years, we will be in the range of 19 to 21%.
All right. And you also, at the start of this interview, briefly mentioned about some defense potential business coming in. What is the update out there?
We've already started delivering defense products in our railway, the applications of the mobility, where we've started getting orders. Almost about 5% of the order book, I think, of complete order book will be coming from defense this side. And electronics, the products are under approvals. I believe in next 4 quarters, we should be receiving those approvals. And from FY26, we will start supplying those products in electronics.
Okay, Mr. Singh, thank you very much for joining us. Great to speak with you here on CNBC TV 18. It's a pleasure. Good luck, sir. That's Amber with Perspective. Stocks absolutely flat right now. Let's talk about Chola next. The stock has been a bit of an underperformer. Of course, it's if you stretch that timeline out a little bit, it's one of the best performing names. In the third quarter, the company saw degrowth in the new business segment disbursals. Of course, that's been a conscious kind of a move from the company. We have Mr. Arul Selvan, President and Chief Financial Officer at the company, joining in to take some questions. So, Mr. Selvan, great to have you back on the program. Thanks very much. The last time we spoke with you, sir, this was at the end of, I think, Jan, you'd said that you are recalibrating growth on the fintech-led unsecured personal loans business, right? And you've been, I think, for the last 2 quarters, guiding for some slowdown on the asset growth side. Could you talk to us about how this quarter so far is panning out? Overall, for the business, for the new business segment in particular. And second, lately we've seen so much more from the Reserve Bank of India. And the general impression the street is making of some of these circulars, etc., is that, RBI is kind of stepping up. A lot of it, of course, is compliance-led with individual cases, etc., you might have noticed. So I just wanted your thoughts on that as well. How is that impacting any decisions you're making in terms of how you are sort of conducting business? Go on, Mr. Selvan.
Yeah. So disbursement is doing well. As a matter of fact, quarter over quarter, that's Q3 over Q4, we should be better than Q3. But as I was indicating earlier, last year Q4 was a very good quarter. Last year Q4 versus this year Q4, you may not see a 40%, 30% level of growth levels, which we have seen in Q1 and Q2 of this year, primarily because the base was low. So you'll see growth happening. Growth is happening in used, growth is happening in PV, growth is happening in construction equipment. And heavies have also started growing a bit. So we should have a good growth. LAP and HL, which are our, the old products, which have now been scaling up in other geographies, is also doing good. So their scale up will also be, bringing in higher disbursements and thereby bringing up the closing assets. Net, I think we should have a decent growth. As I was indicating earlier also, the asset growth should stabilize at around 30% levels for the current financial year over previous financial year. With regard to the RBI circular, I think I wouldn't want to comment anything. We are not into those businesses like a gold loan or into lending against shares, etc. So we are not concerned. And as far as our RBI audit and other regulatory forbearance, we have had good relationship and we have not faced any challenges with regard to any of their comments during the audit or post the audit.
The partnership business, Mr. Selvan, how is that? Could you give us some color? How is that panning out?
Yeah, the partnership business is now again, earlier you have seen the growth to be a little higher because the base was lower. Now it is, stabilizing. Yes, consciously we are also, wanting to little bit keep it on a much safer ground considering the regulatory forbearance out there. As indicated earlier, even before the RBI circular in the commented during our investor one or two intents we will be moving out and which we have moved out. The rest we are doing decent business and we will continue to focus there. We have a reasonably good profit. They are ROA accretive. So we see that happening. As long as we run it tightly, we should have no major issues arising from that.
Sure. Sir, good morning and thanks a lot for joining in. I had a couple of questions on the vehicle piece itself, right? You spoke about growth over there. But within that, what we are noticing in the heavy commercial vehicle space, for example, is that a lot of these large players are seeing a moderation in growth, whether it's Tata Motors, whether it's Ashok Leyland, even a couple of the other players like Eicher Motors. And they speak about how it could be because of the high base of last year, but growth has moderated in certain segments. It could be led to several factors, especially in the heavy commercial vehicle space. Your thoughts here and what do you see as the tenure as we move into election season?
The heavy commercial vehicle is a yield-sensitive product. So when cost of funds moves up, we will have challenges in funding this product at a very low yield because we will not want to have this product, any product for that matter, being ROA impacting the ROA in a negative way. So at these yields, you will not get more than 2% or 2.5% post-tax ROA. As you know, our target is to have 3.5% ROA, pre-tax ROA. So that's where we have also slowed down, and I presume that could be the reason for some of the other NBFCs coming down. But the banks will still fund fleet operators because they have the power of the cost of funds.
Okay, so banks will fund fleet operators, but you're saying that a little bit of slowdown has happened. What do you think the growth could be for your vehicle segment? I'm looking at AUM growth, sustainable over the next couple of years, both in by the end of FY24 and 25.
See, vehicle finance in our portfolio has a large, gamut of products, right from heavies, lights, mini lights, tractors, two-wheelers, passenger cars, and construction equipment, and use segments in each of these varieties. So, and we have demonstrated over the period our ability to move up and move down the volumes in each of these product lines. So that's what we will be doing. So while we will not have growth levels of 25-30% in vehicle finance, but it will still clock anywhere between 18 to 25%. And there is a very large industry level happening. We don't see that. I think, if the coming election throws up a reasonably good results and a strong government comes into play, then we should have a continuing impact, a positive impact of growth in India. And we see that, impacting us favorably.
All right, Mr. Selvan, we missed that number. You said the targeted ROA and ROE is? Mr. Selvan?
Say full company as a whole. I was talking. Can you hear me?
Yes, sir. Yes, sir.
Hello. I was not talking about the ROAs and ROEs of a company as a whole. I was more talking about the ROAs and ROEs of the vehicle finance, more so on the heavy commercial.
Overall, I was telling that the company always targets a pre-tax ROA of around 3.5%. Yes, to that extent, we stick to our level. While we may not, we may be marginally lower or marginally different from our target in this current financial year, but I think over cycles, we should continue to achieve that. And with the new products kicking in, we should improve it in the years to come.
Okay, and finally, give us a sense about how the cost of funds are shaping up and what should the targeted NIMs look like?
The cost of funds have more or less stabilized. I think we should be at similar levels. And I mean, going by the market news, the expectation seems to be in the second half of FY25 that we can expect some cost of fund reduction. The cost of fund levels and the NIM levels would be at the pre-COVID levels for Chola. So we should be in the range of around 7.5% NIM levels as we move into these levels of cost of funds.
Okay, all right, Mr. Selvan, we appreciate you stopping by and filling us in with that broad guidance going ahead. Wishing you all the best, and we look forward to chatting up with you at the end of the quarterly results as well. Well, for the time being, the markets have taken actually a bit of a U-turn. The Nifty Bank, we had highlighted this earlier, that if the Nifty needs to move up, you need the Nifty Bank to head towards a fresh all-time high. And that's not happened. At least as of now, the Nifty Bank has moved towards the day's low. It's down by close to around 200 points. And that's the one that's pulling the Nifty as well lower. And the advanced decline ratio, now you have two stocks that are declining for one stock that's advancing. So we started off with more number of advances. That U-turned, and now, in fact, they're moving apart from each other. Mitesh Thakkar is back with us. Mitesh, I think earlier this morning you were maintaining a positive bias on both the headline indices at least. At what point of time would you choose to buy into the Nifty? We are holding around 22,450.
Yeah. So Nigel, one between the two indices, I think Nifty is the better one in terms of relative strength on the short-term charts. The buying zone for me is around 22,430, 420 on the spot. So another 25, 30 points lower, I think would suggest a long trade with a stop below 22,390. And on the upside, the near-term target, which could be a 1-2 day, 3-day kind of a target, is 22,500. But I think 22,600 plus is what I'm eventually looking at, a slightly swing kind of a trade on the hourly chart. So in that sense, I think, buying around 22,430 with a 50-point stop loss could be a good risk-reward equation. Having said that, the stocks that are on my radar right now, Cipla, I think, is breaking out nicely. So that's a buy with a stop below 1495. Look for targets of 1560 here. And the other one, which I like for a trading bet, is L&T Finance, which is a negative or a sell call. Recommended selling here with a stop just above levels of 163 and a target of around 150, 149 can be looked at.
Okay, by the way, Cipla is at a fresh record high this morning. We understand. I just saw it flash on the ticker. So 1,500 on Cipla. That's a growth of 21% the stock has seen this year. And it's a fresh high that Cipla has hit this morning. Glenmark Pharma is also at a fresh 52-week high. It's at 960 rupees. I remember Glenmark was stuck at, 500, 600 for the longest time. And the breakout actually just happened in the last 6-8 months. So in the last 1 month, it's a 14% rally that Glenmark has seen, and now at a fresh 52-week high. But let's talk about some more stocks that are on the move. First up is Tata Sons. One of the big stars of last week was Tata Chemicals, which rallied 40% over the last 6 sessions. And the reason which was cited was a report from Spark Capital, which suggested that the value of Tata Chemicals holding in Tata Sons was responsible for 80% of Tata Chemicals' market cap, basically suggesting that the intrinsic business was very, very cheap. In fact, Prashant had highlighted this on Friday, where he looked at numbers post the rally. Guess what? Tata Chemicals' FY25 PE had moved up to nearly 18 times from around 12 times. So it is expensive now. Why was the market focused on Tata Sons? Well, that's because Tata Sons was classified as an upper layer NBFC in September 2022, which meant that it had to list within 3 years by September of 2025, basically a year and a half from now. But now we learn from sources that Tata Sons listing in the foreseeable future is unlikely. Tata Sons is considering multiple options to comply with the RBI's upper tier NBFC norms. These options include either reducing their debt, Hiving of Tata Capital could also be considered. Tata Sons has offered no comment when we reached out to them for a response to our story. But for the Tata Chemical stock, this is a clear negative news coming in from a price action perspective, and hence you might see a little bit of the stock under pressure. But let's also focus on another group company, which is Tata Power, which has been quite strong in the last many weeks and months. Vivek is here to tell us more about that. Vivek, over to you.
Well, that's right. Actually, the stock that you're talking about is Torrent Power. Tata Power, of course, was in news on Thursday on the back of the fact that you actually saw price hike coming across as far as the Mumbai Discom was concerned. This is something that the company had been asking, and it turned out the verdict did come in the favor of Tata Power. But the stock, that's actually doing quite well today is also Torrent Power, given the fact that the company has received the LOA, the letter of award, for supply of over 306 megawatt solar power from the Maharashtra State Electricity Distribution Company. The letter of award has been received for the feeder level solarization under the PM Kusum scheme. And this particular project commissioning is expected over the next 18 months. The estimated cost that Torrent Power will incur is 1,540 crore. The tariff is rupees 3.1 rupees for per kilowatt hour, and this particular extension or the time period of this particular project is 25 years. The PPA has already been signed, so that is a clear positive as far as Torrent Power is concerned. With this, Torrent Power's renewable capacity increases up to 1.7 gigawatt. Renewable capacity addition will move up to almost 3 gigawatts. So some positive development in terms of solar power capacity addition and the signing of the PPA for Torrent Power.
Okay, all right, Vivek, thanks a lot for that. Well, time to slip into a short break, but on the other side, we'll focus on the commodity space. Manisha Gupta will be joining in. Stay with us.
Welcome back. Well, shifting focus to the commodity markets, Manisha Gupta is joining in. Manisha, what's the one commodity that you're tracking today?
Well, Sonia, I'm looking at rubber, and most of the industrial commodities, by the way, are doing quite well, and rubber prices in the recent months have been climbing. Actually, 2023 wasn't such a great year for the prices, but 24 definitely has started on a very strong note. So we are trading at a 2-year highs right now. The Indian prices have been on an upside as well. The consumption has been more than the production, and that is the reason you are looking at support coming in. So we have seen prices gain up by 2% in last 1 week, and it's up by 6.5% in the last 1 month as well. There are supply concerns coming in from the producing countries. There have been weather concerns, pest concerns, and is the reason that Thailand, Indonesia and Malaysia, this is where the maximum rubber comes in from the global markets, are looking at lower quantity this time around in sense of production and exports as well. Also, one of the latest reports suggests that Vietnam natural rubber export volume has declined by 161% in the month of Feb, and this is on a month-on-month basis. That has been supportive also. The European Union deforestation regulations is something that the markets are reading upon. And then it is also about the weakness in US dollar index. That one is trading at around 8-week lows. That has been supportive. We've seen better than trade data from China, and that demand improving from the auto and tire manufacturing companies has been on the higher side. A report from S&P Global suggests that the global automotive demand in the month of Feb has gained up by 1.7% on an year-on-year basis. So rubber clearly seems to be taking all the cues from there. When you look at the international markets then, and we are looking at higher consumption patterns there too. When you look at the global rubber, well, the estimates for 2024 are that you could be looking at a production of around 15.05 million tons, while the consumption is anticipated at 15.52 million tons. Remember, rubber has been in deficit since 2021, and 24 doesn't seem to be turning anywhere different then. Look at the Indian markets as well, and here as well, the dependence on imports has been increasing. This is the production trends where we have seen the production kind of continue to gain up for this year as well, 8.75 lakh tons of a production, but the consumption has been jumping by leaps and bounds, and the markets do suggest that you could be looking at higher rubber prices from here as well. A very conservative estimate of around 8 to 10% of an increase in prices is what the industry is working with.
All right, let's take a quick break on that note. Thanks a lot, Manisha, for that. Up next, we'll get chatting with two gentlemen, Sandeep Parekh of FinSec Law Advisors and Jane Gupta, the former executive director of the SEBI, to talk about the recent regulatory actions that have taken place, especially in the NBFC space. So more on that in a bit. Welcome to Bazaar Corporate Radar. Well, recently you've heard of a lot of regulatory actions and governance that has come through in the spotlight. The RBI has tightened its grip on the NBFC space with the recent crackdown on JM Financial and IIFL Finance. SEBI is also taking some corporate governance action where it barred Z promoters from holding key positions. It has also warned Vedanta to strengthen internal controls for corporate announcements. Sandeep Parekh of FinSec Law Advisors and JN Gupta, the former executive director of SEBI, join in now to talk about that. Gentlemen, morning to both of you. Mr. Gupta, I want to start with you first. There's a lot of regulatory action and governance that has suddenly come into the spotlight. What is the big takeaway from this? Is it that there's genuinely a lot of lapses in terms of governance in many of these companies in the NBFC space, or is it just proactive measures from the regulators?
See, I would say let us not generalize anything at this stage. It could be one-off actions or it could be a signal for greater malaise in the system. We do not know at this stage. What we can say at this stage is yes, there are lapses at various levels, and both the regulators, RBI and SEBI, have come out with their respective orders or advisory, and actions is being taken. Now we have to see what happens thereafter. In most of the cases, nobody goes against RBI to the court or anywhere. But in case of SEBI, everybody goes to the court. So let us wait and see who goes to SAT against SEBI. But I would say it is all culmination of issues where NBFC have been an area where a lot of regulatory oversight, although it theoretically is there, but in practical terms it was not there. But now looking into the importance that it is gaining and that every other place you have got a lot of oversight, probably a little bit attention more is being paid to NBFC sector.
And that's always a good thing, right? I mean, as you said, we should not jump to conclusions at the moment. We're not sure if this is a larger malaise in the system or it's just a one-off case. Got that. Sandeep Parekh is also with us. Sandeep, eventually, of course, cleansing of the system is always good for the longer term. But what happens in the near term? Do you see such more of such instances come through? Because it's not just one instance, right? It was back-to-back many companies that were brought in the spotlight and governance issues spoken about as well, or at least allegations made. Your thoughts on how this is going to play out going forward?
Yeah, hi, Punya. So I think I echo what Mr. Gupta just said. In addition, I think, really there are two separate things which are happening in parallel. And, I think it's good to kind of segregate the two. One is the enforcement action that you mentioned. And the second is the RBI also trying to be a counter-cyclical regulator, which means, they have their eyes on inflation and they don't want too much money. They don't want too much fraud happening in the system, which they seem to suggest is going on. So I think it's the two things are going on at the same time, which is obviously having an even larger impact in terms of, how RBI is looking at NBFCs today. The second kind of preliminary point really is in terms of enforcement action. I think I don't think it's really connected to the first point of counter-cyclical measures. I think this is kind of trying to clean the market really, and like Mr. Gupta said, we'll see how much of it sustains and how much of it is kind of either turned down or stayed by appellate courts or in courts, etc. So I think enforcement action is completely separate from the counter-cyclical measures which RBI is doing, but they're happening at the same time. So it's looking kind of lot more harsher for the entire financial system compared to if they were not happening. And then finally, I think it's good that the cleanup is happening, of course, because in times of frauds is when the largest malpractices happen, or kind of people take it too easy. So I think it's probably a good time to kind of take enforcement action.
Okay, good time to take enforcement action. Mr. Gupta, let's talk about the two incidents, right? And in the two spaces that it happened. So the RBI barred IIFL from giving any new loans against gold and JM Financial from giving loans against security. So there is gold, there is loans against security, there's also IPO financing on which the RBI is taking action. What is the impact that you think this would have on the markets? And secondly, do you see any more segments where there could be some stringent action or some proactive measures taken by the regulators?
See, I will answer the second part of your question first. I am neither an astrologer nor a visionary to say that what further action would be happening in what space. But I would say the action that have been taken is very clear that these areas, either whether it is gold loan or loan against debenture or whatever IPO financing, was an area, although everybody has been talking, but it was not looked into that seriously. Now the two cases have come to the light. It will have a cleaning effect in the system, because now those people who were in the comfort that, okay, we are away from the radar of RBI or SEBI, would wake up and say the action could be taken. So I would say in a long term, it is a positive for the market and the system, as the integrity will improve as more and more cases, if at all, comes into the open, so that the company or anybody who's involved in this would think twice or thrice before doing anything which can be caught or which will be on the other side of the regulation. That is one part. The second part is this should also give some sort of a indication to the customer also that, look, what you have been doing was not permitted or what not on the right side of the law. And maybe some customers will also be enlightened and will stay away from this. But again, you know, the memory is short. Something will happen after 1 or 2 years, people will forget it and may start doing again. So that is where the problem will remain for regulators to all time to come.
Sandeep, a final word from your end. This seems to be a widening crackdown on the sector on the whole, right? Many segments are being targeted. It's not just a one-off. What do you think the repercussions of this could be?
Most, I think, like I said, I think two parallel things are happening. One is crackdown on the liquidity, and the second is kind of a crackdown on the enforcement side. And I think one thing which I think the regulators need to do better would be to kind of, for instance, RBI should come out with a detailed order, as does IRD and SEBI, so that people can judge for themselves. As you know, national justice requires a detailed order as to what went wrong, and again, it would help the entire system itself. They know what to do, what not to do. So I think these one-page orders are kind of not helpful for the system as such, because people don't know what has been violated, when it has been violated, whether the punishment was proportionate to the offence created. So I think RBI needs to learn a bit from SEBI in terms of its national justice process.
All right, gentlemen, we could have continued this discussion endlessly, but we have to sort of wind down the show. Mr. Gupta and Sandeep, thank you so much for joining in. Always a good thing when such issues are taken up and, such malpractices are put an end to, and the regulators are doing just that. With that, it is a wrap on Bazaar. Thanks a lot for watching, but don't go anywhere. Lots of stock action coming up on our next show, Chartbusters. Stay tuned.